selling the 142 call, it had a theta of 4 cents. We were buying the 143 to protect it, so that if you subtract those two, we had a 1 cent theta on that one, and the same, we probably had pretty close to the same theta on the downside here. Let's see what we're doing. I think we were doing this one here, the 132 puts. We had a 5 cent theta on that one and a 4 cent theta on the one we were buying. So it came up to about a 1.3 theta, 1.3 cent theta that we were achieving on that position. But theta is strongest at right around the in-the-money options. That's where you achieve the majority of your theta. But it also has a very low probability of being successful. All right. Anyway, we can change. There's a lot of different variables and information that we can receive from this position. Right now, what we want to do is we want to take a look at the extrinsic value. This is the actual amount of time value left in these options. We're going to do a very simple calendar. Remember, all the positions that we put on are based around the basic concept of vertical spreads. The vertical spread I showed you already. You're buying one option, you're selling another. In this case, what we're going to be doing is, in order to create an opportunity in which we achieve our goal of increasing theta, we are going to be selling an option that is at the money. Why would we do that? Because we want the most extrinsic value as possible. In this case, we have $2.61 of extrinsic value at the 138 strike price on the call side. We want to sell one of those to capture that $2.59 in credit. And what happens is, when you do enter an order like this, you don't actually buy this option. What you do is you use margin. In other words, the brokerage company determines what your risk is in this position if you were to sell this one option. And they would margin your account accordingly. They would eliminate that amount of money from your account so that you can't spend it, just in case this position goes against you and you need to have the available cash to buy this option back. The further this gets away from you and the more money you lose on this position, the more money they're going to take from your account and leave it in and not make it available to you for further purchases of calls or puts. And remember, the sale of a option is called naked selling of an option, and it's extremely risky. So we don't do it. However, we do like to protect our positions. We do like to sell options, of course, but we don't like to do it naked or with unlimited risk. In a calendar spread, we know that the front month, in other words, the month that is the very beginning of the very nearest month to the expiration of this particular underlying stock, is June in this case, which has 27 days left. Now there's also June quarterlies over here, and there's another June in here. I think it might even be a weekly. I don't know what these are, but they have a lot of different kinds of option contracts. The one that we're interested in is the ones, now those aren't weeklies because they have 27 days left too, but the ones we're interested in are the front months. These are called the front months. The very next expiration month is called the front month. So what we're doing is we're selling an option, and of course, because we don't like unlimited risk, we also want to buy an option, right? Just like in a vertical spread. Well, in the case of a calendar, the only difference is, instead of buying a option in the exact same month as the one that we're selling, we are going to actually go into the next month, which is July, and we are also, and then we're going to buy the exact same strike price, only a different month. So we're selling a June 138 call, and we're buying a July 138 call. Let me show you exactly what would happen if you did not buy that call in July for protecting your June, the sale of that June call. Let's analyze this. You can see that if the price stays the same or it goes down like you intended, you would collect the maximum profit. In this case is what you sold this option for of $2.59 or $259. However, because you do not have any protection for that option that you sold, you have a theoretical unlimited loss potential on that option if it goes against you. Because you sold the call option, you want the stock price to go down. But what happens if it goes up? Well, let's take a look. If it continued to go up and up and up and up, theoretically it could go to $1,000, I suppose, although this is an index. You would have a maximum loss of $86,574, which is not a pleasant thing to have happen. So we do not sell naked options. What we want to do is we want to protect that position by buying another option at the same strike price, only in a different month. And this is called a calendar spread. They call it a calendar spread because you're buying in you're selling in one month and you're buying in another. So let's analyze this. This is what the graph of the profit potential of this position looks like when we have both the sale of the call and a purchase of the call in the next month out. The purchase of this call provides us with protection, because if the price were to move against us, we would have a limited loss on the position. Our maximum gain and maximum profit on the position is achieved at the exact price that we sold this call for, which in this case is the 138. That's the strike price of the call that we sold. We would achieve the maximum profit if at expiration this stock remained exactly at 138. We have a fairly wide break-even range here between 142 and 134 and a quarter approximately. So in other words, the price can move within this particular range and we would still achieve some profit. However, unlike the naked call, we also have limited risk to the downside. If the stock had gone up to 1,000, like we had in our previous example, the very most you could lose on a calendar spread, on this particular calendar spread, is $136. And I'll show you why it's only $136 in just a minute. Essentially, what you're doing is you're protecting the one that you sold with another one at the exact same strike price, only in a different month. So you're hoping to achieve the maximum profit in the theta decay of the front month option that you sold while trying to maintain the value of the one that you bought in the July month. Because let me show you what this looks like if these options were put together on a graph. You can also see, but in just a second, but you can also see that theta is positive at $1.26. So even though you're buying an option, you're also selling one, and that even though they're at the exact same strike price, because they're in different months, it gives you a positive theta. Also very interesting is, unlike a vertical spread that you would sell, it also gives you a positive delta. It's very important to understand. Let's go back here for just a second. This is exactly what happens to an option as time passes. You can see on this scale is the price of the option, and at the